Hi there. Welcome to Bidwells Industrial Arc Market Seminar, Autumn 2021. Thank you for joining this morning. We're really pleased to have you, and we look forward to giving you an informative 45 minutes. Supply chains, logistics, lorry drivers have all been hitting the headlines in the last couple of weeks, which really underlines how much our daily lives rely on warehousing and distribution businesses. Supply chain security is also a big topic, and onshoring manufacturing and R&D activities is also becoming more important. Sue, next slide, please. Both these trends are feeding heavily into the popularity of the ARC industrial market sector, with UK and overseas investors who are keen to secure exposure to a high growth supply constrained market. As can be seen from this long run yield chart, yields have virtually halved between 2013 and 2021, and we expect further yield compression to occur. This is similar to our lab yield data, where the market has similar characteristics. Sue, next slide, please. This, of course, is due to a number of influencing factors. Weight of money is one such factor, and with investment activity in the ARC already at 821 million this year, we expect 2020's total to be exceeded this year. But other factors are at play. As the bar chart shows, the ARC industrial market has a mix of activities, with the M1 South and A1, A14 corridors dominated by distribution, which is a huge focus for investors, and the Oxford and Cambridge market dominated by the R&D sector, which, whilst much smaller markets, are equally attractive to investors. There are broader structural elements at play, which Sue will talk about in a minute, but currently we've got a perfect storm. We've got many well-capitalized investors, some of which are listed here, who are keen to repeat, buy and build investment platforms. We've got aggressive developers such as Trebor, Bentel Greenoak, Prologis, Rembridge, who are keen to buy the rare opportunities in land that come up and develop speculatively. We've got a supply-constrained market with low vacancy and a strong, diverse occupational demand. Next slide, please, Sue. Here are some deals that we've been involved with, which illustrate the mix. The DHL unit was an investment we sold for M&G to CCLA, distribution warehouse with about 1.5 years left to a break, which CCLA purchased for just under 28 million, which was 3.88%. On the right, we've got the Penlon building at the Abingdon Science Park. We bought a couple of buildings there. Penlon is a ventilator manufacturing company, and we also bought a vacant building next door for Cadans Science Partners, who are going to convert the vacant building into laboratories, and this builds up their already quite large holding on the Abingdon Science Park. And then at the bottom of the page, we've got the Spectrum purchase at Abingdon Business Park, which we made for Royal London and XLB, where we plan to redevelop this building for a multi-let estate that will be developed speculatively by Royal London. So the key theme for today is about growth. Does the expected growth justify the prices? And is this sustainable? Those answering that challenge are Sue Foxley, our research director, with a general overview. Malcolm White will outline our H1 data on the ARC market. Paddy Stanton will cover the big box and Cambridge markets. Rob Beatson will cover Oxford. Paul Davis will cover the M1 South market, and Will Jones will cover Norwich. We will round off some questions, and you can use the box at the bottom of the page to send them in. So Sue, let's start with you.
Thanks, Paul. So I'm just going to very quickly pick out a couple of themes that will come through in the discussions later on from Malcolm and then the team in some of the deals we're seeing. So the first point, just on the distribution side and looking at online sales. Now we talked about this for those of you who joined us in February earlier in the year, and we can sort of see how we've seen an upshift in terms of the trend in terms of online sales. As a result of the pandemic. Things have actually dipped back quite a lot, but appear to be stabilizing. But I think it's far too early to tell how that is all going to pan out. And of course, there are additional challenges at the moment. So just-in-time delivery is actually quite challenging. And so supply models have changed, which was added to demand in terms of storage requirements, and actually facilitating supply chains in the production and manufacturing process as well. So this is a very live issue, as we know. We're kind of watching the news at the moment, but a sector that was already growing very significantly had the COVID overlay, and then on top of that, Brexit issues and the like, is challenged during a growth period and a period where the economy is opening up, and so there are a lot of pressures there as well. So we are seeing that in the market, and I think Paddy will probably talk about that in a bit more detail. I think the other side of it is the manufacturing, and just really wanted to pick up on how positive the confidence is in terms from the manufacturing side. And actually there is actually pretty good data in terms of the manufacturing contribution to the economy. And now this is of course the opening up of the economy and this sort of surge in growth, which is such an unusual and unique position of going from very little to a very large pace of growth in such a short period of time. So confidence is high, but actually in terms of actually delivering on that is tough. So with costs rising and supply chain issues and even sort of more structural issues in terms of microprocessors and shortages like that. So the car industry is doing really well, but is being held back by that tech side. But if we actually think about it in terms of the ARC context, a large part of our occupational base is very high tech, and really we think, you know, a large significant amount of that stock, 2 to 3 million square feet, is in knowledge industries, and Paddy's going to talk a little bit more about that, as will Rob. And just examples of some of the companies that, for example, we've seen coming out of Cambridge University and also out of Oxford University are taking that space. So it's completely transformed, particularly Oxford and Cambridge, in terms of the traditional industrial market. And it's a question whether that really is quite the same, or a separate sector really. So with that, I'm going to hand over to Malcolm, who will talk about market stats and really what's been going on in the market over the last 6 months or so.
Thank you very much, Sue, and good morning, everybody. Just on to the next slide, please, Sue. Just before we start, I think just to recap, we've talked about the different markets and emerging markets that are sort of developing in and around the ARC. We have the more core distribution zone in that central M1 South area, and the two high-tech specialisms of both Cambridge and Oxford. But what's really started to happen over the past 18 months or so is that sort of area up from Felixstowe up towards Peterborough that's started emerging as a key distribution location. And just to put some flavour behind that, if we move on to the next slide, please, Sue. The sort of rental tones that we're seeing, and perhaps this is part of an explanation as to why this emerging distribution zone is starting to develop out towards the east of Cambridge. It is rental tones are about 650 to 750 in that sort of area. We can see that in the M1 South, anywhere from £750 to £9, and in those two high-tech and small-scale specialism areas of Cambridge and Oxford, we've got rents very much being driven by high-tech and mid-tech occupiers that are pushing up towards 15, 17, and I think in certain examples up towards £20 a square foot. On to the next slide, please, Sue. So Saul has alluded to the sort of growth story that's really been underlying. We've seen yields come in by best part of 3.5 to 4 percentage points over the past 7 years or so. And strangely enough, what's happened is that's pretty much been matched by a strong rental growth period. So from 2013-14 through to mid-year this year, we've seen rents grow in general across the arc by about 60%, 6.9% on average. Major increases really in that bracket seen in Oxford, where prime rents have pretty much doubled, and in Cambridge, where rents are up by almost 60% as well. We are forecasting growth going forward of circa 28 to 30% over the next 5.5 years through to 2026. Annualized growth rate of about 4.9% per annum, slowing down, bit of a peak in the next 18 months to 2 years, but then settling back down to more normal levels towards the end of that cycle. Next slide, please, Sue. So placing all of that into perspective, this is historically what's happened across each of the markets. We can see very strong growth, certainly since 2014 in Oxford, of best part of 10 to 11% per annum. And Cambridge and Norwich not far behind at sort of 6.2 and 5.7%. Average across the arc as a whole, 6.9% over that period of time. What are we expecting going forward? Sue, on to the next slide, please. These are the growth rates that we're expecting. So at the moment, there's a slight rental disparity between the Oxford and Cambridge markets. We see that disparity closing over the next 3 years or so. And then beyond that, we think those markets will move pretty much in sync. The other markets, the key distribution, core distribution markets, slightly lower levels of growth. And similarly, Norwich, which has seen quite a strong period since 2014, showing some sort of slowdown. Next slide, please, Sue. But it's not just prime rents that have been accelerating and showing strong growth. The secondary market has pretty much matched that, slightly later in terms of the way it picked up. So it didn't really start accelerating in terms of growth rates until 2015-16. But over that period of time, pretty much married, but compressed into a shorter timescale, pretty much matched what we've seen in terms of growth in the prime rental market. Just to place this into some sort of perspective, we've seen 6.9% per annum growth in our prime rents over this period of time, and indeed secondary rents. If you compare it to the growth that we've seen on the MSCI industrial index, that's been running at about 4% per annum over that same period of time. Next slide, please, sir. And in terms of growth rates, what we can see there is the sharp acceleration in secondary rents in that 2015, the catch-up period that really started to happen. We've seen prime rents bounce back in the first half of this year. We've got growth of circa 10, 11% so far this year. And we've already got built in, I think, even since the end of H1, we've already seen rents in some of the markets move ahead a little bit further. We're expecting rental growth to peak out at around about 12, 13% in 2022, but then start to ease a little bit as we go forward. And hopefully, as supply chain issues start to get a little bit more sorted. So what's been the real sort of driver, if we move on to the next slide, Sue, and then flip on again, what's been the real driver behind this rental growth story? And I think in past, we've seen fairly strong demand from occupiers, but that really has accelerated since the middle of last year. we've seen an increase of around 77% over this time last year. And we're now standing across our ARC patch or across our markets at demand standing at about 25 million square foot. Heavily driven, it's worthwhile saying, by demand in the big box sector, which stands at about 19.4 million square foot. That's more than doubled over the past 12 months. So we've seen a doubling in big box demand as those supply issues and supply chain issues start to come forward. Next slide, please, Sue. And breaking down our demand picture amongst all of the locations, we've seen strong growth in that M1 South core distribution market, increase of about 141% over the past 12 months. Cambridge demand up by 75%, and similarly Norwich demand up by 102%. The demand levels in Oxford have remained fairly stable over this period of time, although I think we've had quite a strong period of activity, letting activity in the Oxford market. So maybe this is a bit of a lull before a storm. Next slide, please, Sue. And of course, all of this in terms of demand levels is arising at a time when we've probably got supply at historically low levels. In terms of availability rates, we've got an availability rate of, I think, 4.1, 4.2% across the ARC. Grade A supply, I think there are a few development schemes, and maybe some of the guys will talk about the schemes in their particular areas. Majority of it's focused in and around the core distribution markets, but grade A supply below 1 million square foot. 2 grade A big box units and 3 second-hand units in the M1 South. Again, a major focus. We've also got 1 grade A unit of 190,000 square foot, Didcot 190 in the Oxford area. Aside from that, we're pretty much bereft of any big box grade A space. Next slide, please, Sue. And in terms of each of the regions, again, we've got M1 South availability rate 4.2% at the end of H1, down from 4.6% at the end of 2020. Norwich availability rate down from 4.1 to 2.7. Cambridge down from 3.7 to 2.4. And we've seen a slight uptick in supply in Oxford, but that's primarily due to some newly completed schemes coming to the market, primarily at Didcot. And then just looking at the grade A picture, literally across the market, as I said, we've got about 700,000 square foot, 800,000 square foot. Some of that focused in Oxford, a lot of that in the Didcot building. M1 South, we've got a couple of grade A buildings, large buildings in M1 South, but not much else. The interesting picture, I guess, is in the Cambridge and Norwich markets. No new grade A space in Norwich, and only 6,500 square foot in Cambridge. And it's worthwhile saying that in Cambridge, that's following a fairly successful leasing or letting up of 2 new schemes that came to the market. On to the next slide, please, Sue. So doing our usual analysis, which is comparing current supply to demand levels, and this is across our major locations as a whole, what we can see is really across the whole market, we have undersupply of floor space for all of the requirement levels that we've got out there. The 2 key areas, I guess, is in that mid box, that 50 to 99,000 square foot range, and in that big box market where we've got a shortage of supply and undersupply ranging to about 18.1 million square foot. And looking at each of the locations, onto the next slide, please, Sue. Each of the locations, again, across all of the markets, it's worthwhile saying the solid blue is where we were at the end of the year. The dotted line shows us where we are now. The supply conditions in Cambridge clearly just worsening. We've had a little bit of a release of space in smaller space, sub 20,000 square foot in the Oxford market, but still the major shortages really across the rest of that patch. MK market, I guess, is really the key one here in terms of that big box demand. 13.6 million square foot under supply of big box space in Milton Keynes. Next slide, please, Sue. And in terms of activity and in terms of letting activity, we've actually seen 2020, despite a slow first half of the year, which wasn't surprising, I guess, we've seen a fairly robust second half of the year and first half of this year. We're going at about trend levels of activity. Next slide, please, Sue. The main slowing in activity in the ARC this year has been in that, this is just looking at take up by size band. The main slowing in activity has really been in that big box market, probably partially driven by lack of supply. Interesting to note here that the mid box market, 50 to 99,000 square foot, very active in H1 this year. Next slide. Thank you. And just summarising in terms of the types of occupiers that have been dominating activity across our three major locations, or those three locations. Cambridge really dominated by IT and comms and high-tech manufacturing, best part of 60% of all activity. And also an interesting thing, I think, is the real estate and construction sector, obviously with the levels of building that are going on in these areas, an increased demand from construction companies. Similar sort of story, although a little bit more mixed. We've seen about 35% of activity in Oxford by those knowledge intensive industries, with a little bit more distribution and traditional manufacturing. The M1 South market, I suppose unsurprisingly, dominated by distribution, although we have seen a lot of high-tech manufacturing. I think the likes of Red Bull taking units in the area. And just summing up on the picture, if we move on to the next slide, what have we seen so far this year in terms of activity? Pretty much a trend, above trend levels of growth across most of the markets. And worthwhile focusing in on the figure across our four major locations, 5 locations, because we've got Northampton in there as well, 2.3 million square foot of take up. Let's just focus on that emerging distribution cluster, that sort of Suffolk, Felixstowe, out towards Peterborough, where already this year we've seen best part of 2.4 million square foot of acquisitions. And again, I think Paddy will touch on some of those deals. That's everything from me. Look forward to any questions, and back to Paddy.
Thanks, Malcolm. Thanks, Sue, for your notes as well. It's informative as always, and some great stats, I think, to take away with us, given where our markets are, especially Cambridge. That 2.4% vacancy rate, which I'll talk about in a minute, is really quite an interesting nugget, I think, going forward, that we all need to be wary of. Good morning, everyone. Thank you for your time giving up on a Tuesday morning to come and listen to us, hearing about our markets. I think, as Malcolm has said, they're some of the most dynamic in the UK at the moment. I think if you tuned into a webinar with us probably 10 years ago, the 3 or 4 of you that would have made it would have probably heard stories about rents growing 25p a foot for 5 years and possibly yields hardening a little bit to sneak below 10%. So where we are now, I think, is an incredibly dynamic market with the growth rates that we're all talking about. This morning, I'm just going to have a quick canter through 2 of the markets that I specifically look after. So the big box across that emerging corridor, as Malcolm's mentioned, and then a little bit on Cambridge and what's going on there, and how I'm going to be out of a job probably in the next 2 or 3 years, as most of the developers are turning my buildings into Shoreditch office parks and other biomedical campuses. First slide then, please, Sue. So what's going on in the emerging distribution market that Malcolm's touched upon? I think it's fair to say that the East is now firmly on the map, much like the M40 corridor. Previously unfashionable locations such as Peterborough, Ipswich, Bury St Edmunds, and to some extent Huntingdon is truly starting to have their time in the sun. The availability of the larger land spaces and cheaper rents, the multinationals are really starting to rethink their traditional Golden Triangle locations and instead favour closer access to Felixstowe and the improved transport links that the A14 bring between Cambridge and Huntingdon, and also, very importantly, which we're hearing a lot from occupiers at the moment, the accessibility to labour pools, given the tightness of staffing on the M1 corridor and other locations, and the cheaper rates that they can be secured at. Well, I was with an occupier yesterday, and they're saying that Amazon are now offering £25 an hour for night shifts. So I think everyone's going to be struggling for the Christmas period. It's also worth noting, probably 4 or 5 years ago, if we had 2 or 3 requirements of, say, 100,000 square foot and above in a single year, that would be a pretty impressive year for the Eastern region. Whereas, as you can see here, we've been involved in 3 specific deals, over 600,000 square foot each, which is quite a staggering statistic, just sort of, again, enhancing just how the East has really been put on the map. Next slide, please, Sue. However, there is the danger that the East is starting to become a victim of its very own success. We've been involved in the 2 lettings at Gateway Peterborough, which were the 2 speculative units built by Benfield Greenoak towards the end of 2020. They became on stream early in the year. We let MH Star within about 3 months, and Oatley's literally just completing very shortly, both of which will take out the only 2 available buildings that have been built in that time, which will then only leave, quite staggeringly, only 1 building available across the whole Eastern region over 100,000 square feet. And that's the building at the bottom there, the 736,000 square foot former Debenhams warehouse in Peterborough. So you can just see that when that letting goes and completes, which may or may not happen quite quickly with Amazon, depending on how those negotiations go, there will then be nothing available over 100,000 square feet, sort of the east of the A1 corridor, which is where we call our emerging markets. It's quite an amazing statistic when you consider that we're probably tracking over 6 million square feet in demand at the moment. So we're all not sure what's going to happen and where they're going to go. Next slide, please, Sue. Developers are on the charge, trying to sort of encapsulate some of this demand and get buildings coming out of the ground as quickly as possible. But there will be a short hole in supply until at least the end of Q2, early Q3 2022. There is, given the demand that we're expecting, or the demand that's in the market at the moment, there is going to be a lot of pre-let activity in these schemes, and we're already having conversations on a number of them, which is a promising sign, given that occupiers and developers aren't having to wait and see their void periods increased. We've seen the likes of Technologies taking 100,000 square foot pre-let at Haverhill, Hermes taking 80,000 square foot at Suffolk Park, all on a pre-let basis, which again is incredibly encouraging. Interestingly, the Hermes has literally just been forward funded at 3.5%, which I think is a real statement for the Eastern region, and further highlights that the investors are starting to shift their focus away from the M1 Golden Triangle and follow the occupiers further east. Next slide, thanks, Sue. So just very quickly touching on Cambridge and my soon-to-be non-existent industrial market. There are a few examples I put on here of where my industrial units, where we've worked with clients effectively, speculatively developing more mid-tech and office accommodation to repurpose and transform them. It's fair to say that all have taken a calculated risk in undertaking the work speculatively, but I think it's paid off in rather fantastic fashion, as you can see from the movement in the rents. moving from sort of the early late digits of £8 to £10 a foot up to close to £30 a foot in some of the locations. But you can see very much sort of the shape of the buildings doesn't change. It's all mezzanine floors, partition walls, which aren't incredibly expensive to undertake, but the feedback on the rents is quite dramatic. It's also led to a lot of the new industrial, in inverted commas, schemes being designed from conception with these occupiers in mind. So the likes of the Bourne Quarter there in the bottom right in Cambridge Research Park, developers are building shell and core, but putting extra glazing in, the additional car parking, additional landscaping, exposing services, almost making it oven ready for an occupier to come in and fit out how they wish. I think there's a balance between, do you create the shell or do you go full hog? I think it depends on developers' expectations and their confidence levels in other supply. Next slide, please, Sue. I think this is all fine in terms of developers looking to repurpose and transform. Clearly, that's where the rents are going. That's where a lot of the demand is for Cambridge. But let's not forget that there's still an industrial market that needs to be looked after in and around Cambridge and what we call sort of a 15-mile radius. This map shows the authority's proposed employment map from 2024 going forward all the way for the next 10 years to 2034. And if you look at the red allocated sites on there, they are the employment ones. And very quickly you can strip out probably the ones on the right-hand side of the M11, the likes of Marshall's Airport, the Northern Fringe development around the new Cambridge station, and also the Genome campus, because they're probably going to be more R&D and office campuses, which from a very quick analysis will only provide, or the remaining space will only provide approximately 750,000 square foot of new supply to the market across the next 10 to 12 years, which is quite a staggering underassessment of where the market really needs to be. If we're tracking sort of 2 million square feet of demand as of today's date, which we can only see increasing going forward compared to our statistics, I think there's going to be a worrying lack of supply. As I say, the 2 million square feet is really going to put a strain on the supply levels going forward. But what we're really wanting the authorities to do, and through our lobbying and speaking to the planners, is creating a new site where we can get up to the sort of 3-4 million square feet of demand that we expect to be needed in the area. And let's hope they do embrace this. Otherwise, I'm certainly going to have to be moving up to Peterborough, where they are embracing more industrial type development, as they see the benefits that it can bring to the economy of extra jobs. The business rates of 4.5 million square feet is not insignificant, and also just the growth of the economy. So I'll leave you with that, and I think I'm now passing over to Rob, who's probably going to tell you a very similar story in the Oxford market. Thanks for listening.
Thanks, Paddy, and good morning, everyone. As Malcolm has said, the first half of 21 has seen significant take-up of industrial stock in Oxfordshire. This has largely been driven by the science and tech sector and the logistics sector, the largest deal in the market being Simon Heagle's 120,000 square foot letting at Didcot Quarter. The science and tech sector as a whole accounted for around 38% of total take-up in H1, with the logistics sector following on, and then what we would term as traditional industrial occupiers after that. So therefore, it's very much the mid-tech product, as Paddy was talking about in Cambridge, which is also being chased in the Oxfordshire market and which is really pushing rental values on. Sue, if you could just flick to the next slide, please. So we continue to see increased appetite from the science and tech sector for this type of product. And this is not just within advanced manufacturing, engineering and aerospace, which previously led demand, but across all sectors, including life sciences and quantum computing. Now, as we have flagged previously, we continue to see record levels of capital investment coming into Oxfordshire's science and tech community. And this demonstrates the maturing of the ecosystem and is also now triggering demand for larger scale facilities at, say, 100,000 square foot plus, so directly competing with the big box and logistics operators. As the pictures in the slide show, occupiers are taking space and then fitting out to provide a mix of office, and in the case of the life sciences guys, laboratory accommodation. Now, a mid-tech product gives them greater flexibility in terms of fit out, as it gives a blank canvas and it is obviously at a much lower price point when compared with some of the bright, shiny, lab-enabled type products that are in the market today. We're also continuing to see growth in demand for biomanufacturing space, and this is a crucial area which will continue to increase, especially within Oxfordshire, due to the key fundamentals within the region, i.e. the continued growth and development of life sciences, the impact of COVID and Brexit, with many companies now wanting to keep manufacturing in the UK, and the development of national centres of excellence within the region. For example, the Vaccine Manufacturing and Innovation Centre currently being built on the Harwell campus, which is due to open later in the year. So this biomanufacturing space is typically a warehouse type building of between 50 to 100,000 square foot plus, often with upgraded power and M&E provision when compared with a more traditional industrial type offering. However, the challenge that we are seeing at the moment, and something which our clients are raising to us, especially within the life sciences sector, is that they're struggling to align their timings in terms of demand with supply of available options, as they struggle to sign pre-lets due to still being in, say, clinical trial phase, but there's still a significant risk that they might not actually need the space if the results don't allow them to take that next step on into manufacturing. However, once they clear that, they then need the manufacturing space almost immediately, as the fit out period for a GMP facility can be extensive. And there's therefore often this misalignment within the market due to a lack of supply. Now, whilst the regional parks and campuses are trying to solve this issue, so at Harwell, for example, there's a strong development pipeline looking out across the next 6 to 36 months, we are seeing a number of organisations look outside Oxfordshire and looking actually across the UK to try and find GMP facilities that will suit them and align with the timings of when they need to be operational by. However, we will continue to see this growing demand for biomanufacturing space during the rest of the year and moving forward into 2022 in Oxfordshire. And it's certainly an area of the industrial market that should be focused on and watched and monitored, because it's going to be extremely high growth. I'll now pass you on to Paul, who will talk you through the dynamics being seen in Milton Keynes.
Thanks, Rob. Morning, everybody. Yeah, well, it's, oh, excuse me a second. Yeah, well, as we've seen, with sustained record levels of demand and continued lack of supply across all size sectors, not only seeing rental levels increasing, but also this is driving on some well-needed speculative development coming forwards. Back in February, I focused on the new developments underway in both Northampton and Milton Keynes, which were sort of mainly big box, and being 8 months on now, you know, those developers that have taken the plunge are now reaping the rewards. There are a number of recent deals that have happened. You've got Firethorn Trust's Northampton Cross development now being fully let to MH Star. I noticed Paddy mentioned them doing a deal in his neck of the woods as well. You've also got GLP competing a couple of deals, one in Northampton to Whistle taking a second unit there at their G Park scheme, and also the letting of Magnitude 88 over in Milton Keynes to Woodman Stern. Also in MK, you've got the Baytree Fennylock development, which is well underway, and they secured a pre-let to Tutti Bambini of 72,000 square feet. It's good to see also that there are more speculative developments coming forward. Certainly in MK, the largest spec development for a while will be PLP's 2.2 million square foot logistics business park over on the A5. They will be starting phase 1 shortly. quite refreshingly with this scheme, it's not just focused on big box units. Phase 1 comprises of 10 units ranging from as small as 15,000 square feet, but also up to bigger sheds of sort of 308,000 square feet. We've also seen 2 recent site sales being agreed in Milton Keynes, which will further bring future development forward. First one is a joint venture between Equation and Bentham Greenoak, who we've touched on before as well. They've taken on a scheme called Code, which is a 7-acre site up on Denby West, which will bring 2 units forward. One of 136,000 square feet, but again, just sort of rationalising the site, a smaller unit of about 20,000 square feet. They are reported to have paid in the order of 1.8 million an acre, which at the time was a new market high for MK. But shortly after that, Tremel Crow have come in and purchased what was the old Arcadia distribution centre over on Redmoor of 19.4 acres. That will provide 3 units of 340,000, well, 3 units comprising 340,000 square feet, a 212, a 70, and again a 50. And they then took the market land price forward, and it's reported they have paid in excess of 2 million an acre. So interesting stats. The slide you see in front of you on the screen is again another speculative development we've been involved in. This is on behalf of Schroders, and it's a small unit scheme that was completed last year, Heathfield Gateway. It comprises 6 units ranging from sort of 3 to sort of 2 to 3,000 square feet. We've recently completed the letting of 3 units totaling just over 8,000 square feet to Strata Creative. These guys are operating from there the customer and test drive hub for electric car manufacturer Polestar. The interesting about this deal is it cemented a new industrial rental level for small units of £14 a square foot. Subsequently, we are about to instruct solicitors on another 2 units down there, similar rental level to a single occupier, leaving just 1 unit remaining, which is generating good levels of interest. Next slide, please, Sue. This slide relates to a unit over on Kiln Farm, K3, which forms part of a 3-unit scheme owned by Mileway, which we are coming close to completing a comprehensive back-to-frame refurbishment programme on. Partway through the process, a pre-let was agreed on the largest unit there, K2, which is 50,000 square feet. That completed at the back end of July, leaving just K1, which is 40,000 square feet, which is also now under offer, and K3, which I mentioned there, which I've just seen an email this morning confirming that we've agreed heads of terms on that one as well, which is great news. These last 2 deals should complete before year end, which is also good. During the refurbishment programme, we received a sort of steady stream of interest in the development. And it just shows going forward that when clients, with the lack of supply that we've got, and clients are refurbing premises such as this, we are able to push rents on and maximise our investment value, which is good news. We've got 2 or 3 other clients that are doing similar refurbishments at the moment, which will come on stream, a 50,000 square foot on Tonwell for Columbia Threadneedle, an 84,000 square footer on Mount Farm for the Charities Trust, and also a 33,000 square footer for Royal London on Breaklands, which is already under offer and due to complete the AFL shortly. So what I would say now that basically all this sort of positivity in the market and demand that doesn't seem to be waning is driving forward. The rents are moving on, developments are coming forward. So yeah, long may it continue. An interesting time ahead for industrials. On that note, I will pass over to Will in Norwich to round up. Thanks very much.
Thank you, Paul. And good morning from a slightly drier Norwich than it was a couple of hours ago. For those of you who attended the spring webinar, you'll remember that 2020 was the best year for the Norwich market, with take up at nearly 550,000 square feet. The first half of this year has continued very much in the same vein, with take up totaling 207,700 square feet, and supply continuing to fall to just under 300,000 square feet at 295. Given we still have in the order of 900,000 square feet of requirements in our books, I guess take up could have been more, but it was really held back by the lack of stock, and in particular units of over 20,000 square feet in size. Next slide, please, Sue. Now, the largest deal to take place during the first half was actually the sale of the former Aviva data centre at Barnard Road at Bowthorpe, which was 70,000 square feet, which was purchased by owner-occupier Lifeline 24. Now, this slide shows the largest letting to take place, which was a speculative unit, which was speculatively built by clients of ours, Harbour Properties. It was the first spec unit to be built in Norwich for many years, 20,000 square feet, and we let it to a company called Berkshire International on a 15-year lease at the new rental high of £850 a foot. So that pushed on rents from probably about £725, £750 up to £850 a foot. So what's been happening in the intervening period between the end of June and now? The answer to that is very much more the same. Next slide, please, Sue. Again at Gateway 11, this is of 702 Penfold Drive, which was refurbished when the previous occupant left. It was also extended, so the warehouse you can see on the left of the slide there is an extension because the property had a very large site area. 25,000 square feet, a slightly higher than average office content at 6,700. You can see the offices on the left there, and this was let on a 20-year lease with a 10-year break to Cadent Gas, and we're now looking to sell the investment of this. Next slide, please, Sue. Broadland Gate Trade Park on the east side of Norwich was a partially spec built unit by clients of ours, Norfolk Land Development. A terrace of 7 trade counter units, ranging, as you would expect, in size from about 4,000 to 6,000 square feet. We've already attracted the likes of Screwfix, Howdens and Toolstation, and we're just about to complete on Unit 1 at the asking rent of £9.75 per square foot. Next slide, please, Sue. This is of Diamond Point, which is on Vulcan Road, just to the north of the city centre, a short drive from the outer ring road. It was a site that we bought for Chancery Gate back in 2019. Now, Chancery Gate have subsequently sold it on to Northwood investors, along with a few other schemes they've been developing in the region. And this will be formally handed over at the end of this month upon completion. So this isn't included in our supply figures yet, but will be for the second half of the year. The front 3 units all range in size, 15, 18 and 20,000 square feet. So that should help to plug some of the demand for the bigger units. And then the two terraces at the back provide smaller units ranging in size from 3 up to 6,500 square feet. And we're actually looking to push rents on from 850. We're quoting 925 for the bigger ones at the front, and then between 950 and 975 for the smaller ones at the back. So really, in conclusion, the supply of available units is at an all-time low, as Malcolm pointed out. It will be bolstered by the completion of Diamond Point. Demand remains strong. The average size of the requirements is getting larger. So we've actually got 3 or 4 requirements now for over 100,000 square feet. And rents are continuing to rise. Thank you.
Thanks, Will, and thank you to everyone for their comments there. If I could ask you to all unmute yourself, and we've got a few. We've got a few minutes now just for questions. So first one just that has come up first is initially sort of really where does this all go, given the shortages we're seeing and the stock, the limited stock that's coming through or has the capacity to come through, where is the flex in the market? Is it in terms of fitting more space onto the sites? Is it that rents will continue to rise, or will occupiers have to start looking in other locations? And I suspect that the story is a little bit different in each of the markets. So Paddy, maybe if I can start with you on that.
Yeah, I mean, I think the thing that we're just seeing having to give at the moment is definitely rents. You know, the supply demand dynamic is something that we've never seen before. I think a lot of it is being pushed onto the occupiers, and it's not being helped by, well, yields are going one way. Ordinarily, you'd think the rent should be able to go backwards, but the build costs on new kit, the demand that's in the market, we're seeing people, we're having sort of gazumping battles at the moment in and around Cambridge, people sort of taking or asking occupiers, would they consider moving to bigger premises, and being aided in doing that by other occupiers. So I think it really is that supply. Most of these occupiers have only got one unit to look at, so it's really just pushing the rents, and I don't see that changing. You saw the slide that we've got in our pack in terms of where the available land's going to be, and given the fact it's just not there, I just can't see it sort of changing in the short term, unless something dramatic happens on any site sort of magically coming through. But given the time it takes for them to get from even an allocation to an outline consent to then buildings being delivered, you're looking at 3 and 4 years. So I certainly see the pressure being kept on Cambridge markets and the emerging distribution markets we've talked about for the next 2 or 3 years going forward.
And in terms of sort of rental, can you see that is there a sort of ceiling in terms of where rents will be going given affordability? Because there's a lot of other pressures on the distribution operators in particular at the moment. Yeah,
I think for the big box guys, I mean, they run their margins off such, they run their businesses off such small margins that I think there will be a ceiling from where they can get to. Can they realistically pay 12, 13, 14 pounds a foot for a 100, 200,000 square foot unit? I think that remains to be a challenge. I think for the tech guys, it's not a problem at all. You know, when they're comparing it to an office rent of about 30 to 50 pounds a foot, it looks cheap. So that's where we're seeing the huge growth. But you know, stories coming out of North London at the moment in terms of rents getting up to 30, 32 pounds a foot for industrial kit down there. That is probably going to ripple itself out eventually. I think the question will be whether the true industrial occupiers can afford to pay those rents. I think that's where I see the problems going, and I'm not quite sure what the answer is for those occupiers, unfortunately. You know, do they have to look at taking more 3PL space, but those guys are going to be charging higher storage rates than they ever have been before to try and compete. So it's a really interesting dynamic for the standard sort of B8 logistics guys, I think.
Yeah. Rob, how is that evolving in Oxford in terms of traditional occupiers and how the displacement now?
I think it's very similar to sort of what Paddy was talking through on Cambridge. Really, what we are seeing are traditional occupiers being pushed out of certainly the prime estates in and around Oxford as the science and tech guys move in. As Paddy was saying, the science and tech guys tend to be less price sensitive, and that's really what is driving the rental value growth. But that's also pricing out other more traditional industrial occupiers, and so they are tending to move out of proximity to Oxford, so going west across towards Witney, and then north up to Biston, south down to Didcot, and really in and around Oxford we are seeing a huge growth in occupation by science and tech occupiers, as I said, across all sectors. So life sciences is the sort of hot buzzword, but actually it's manufacturing, it's aerospace, it's all sectors of science really that are taking advantage of these industrial type products.
Yeah. And Paul, are you seeing any displacement of traditional manufacturing towards your market?
No, I mean it's an interesting one, because what we are seeing is obviously rental levels are moving on, and as stated, we have a number of landlords that are refurbing their premises to maximise this. With the new developments that are coming forward, we are seeing some of the smaller size requirements coming forward, but it is still dominated by big sheds. So we are seeing sort of local occupiers really are having to sort of possibly remodel their business, and sort of either dig deeper in their pockets, or doing sort of interesting things with mezzanines, etc., in their buildings to try and maximize space. The other dynamic that we are seeing is, as we stand here today, Milton Keynes is still currently rental levels are going bananas further down south, down the M1 and within the M25. We are starting to see now a bit of a sort of an influx to Milton Keynes from occupiers in those locations that are now facing rental levels that sort of some locations are £30 plus. So if they can afford to travel the distances, it is making Milton Keynes look comparatively cheap compared to those other locations.
Okay, that's really interesting. And so just 30 seconds maybe on because we're coming up to time now, just in terms of how investors are viewing that, in terms of the longer term potential in the region.
I think it's it's all about relativities, and you look at our location, the art location, we're a very economically vibrant location from a diverse set of influences. You've got industrial, distribution, tech. You're not very far from London. So I think relatively investors look at this area and believe it's a high growth market. So my view is that pricing will maintain the momentum that it's already got and increase. And I think for as long as we see the rents coming through, because of the demand being higher than the supply, that pricing will be sustained.
Yeah, brilliant. Thank you. Well, thank you all very much. Thank you, Malcolm, for a great presentation and all the analysis. Thank you to everybody for joining us. We're a couple of minutes over, so apologies for that. It is a fascinating market, and we're fortunate to be working and analysing it in my case. The reports will be with you over the next day or so. We're setting out all the stats for this, so look out for those. And I guess we look forward to speaking again on this in the new year, which is an awfully long time ago, but I guess that will come around really quickly. So thanks again for your time, and have a good morning.